Hello and welcome to Las Vegas. We are at the 6th annual edition of the Infrastructure Summit by Structure Research. Joining me in the event is Jared Day, President and CFO of Compass Datacenters. Thank you so much for joining me.
Happy to be here.
How has your Vegas experience been so far?
It's been great.
Great. Well, we'll go with the theme of the conference is concurrence, and there's a lot of things shaping the industry currently. There's a lot of things, moving parts. Tell me one of the main things, I guess, which is pushing the industry forward currently.
Well, obviously the demand is just off the charts. You know, what we're focused at Compass is building a scalable machine, and we call our business a machine because we have spent a lot of time and energy trying to align sort of our land bank with our supply chain, with our organizational capability, and our capital. You know, those are really the four pillars, and we're trying to size all those in a thoughtful and consistent manner so that we can have, you know, healthy growth but moderate growth that's de-risked and that allows us to achieve our strategic objectives, which are, you know, speed of delivery, build cost, and, you know, we say built to last, but really that means future-proofed data centers that are able to evolve as the technology inside evolves.
How is your company prioritizing capital allocations across the company's portfolio?
Well, you know, we're pretty selective at Compass. We are focused on a very large but narrow segment of the market. So we will really only take on business from investment-grade tenants. We will only take on business that is a workload that we feel like is going to be there forever. We know there's we're very, very limited renewal risk. And so the selectivity that we apply in sort of the business development funnel means that only the stuff we want to do gets to the funnel, and it's all funded just based on those four priorities I listed earlier.
So how do you judge whether a portfolio is going to be there forever?
It's a good question. You know, first of all, it starts with the tenant, right? So investment grade tenants that have been around for a long time and have proven business models, right? So we want revenue to be generated in our data centers, and we want, you know, it to be a strategic core part of our investment grade tenants business. So there's a lot of great business out there that is more speculative, and maybe the returns are higher, and I'm sure a lot of those players are going to be really successful. We have made the decision at Compass to focus really on risk-adjusted returns, and I think one of the things that I see in the market are pretty similar return profiles, not enough of a difference on the risky end of the spectrum for our liking. So, you know, we think that even the safest business, you know, the least risky business in our industry right now provides a pretty attractive return. So that's what we're choosing to focus on.
So I guess it goes against the saying, low risk, low return. So does that, I mean,
yeah, I just think there's a disequilibrium right now where people are taking a lot of risk that they might not understand and are not getting appropriately compensated for that risk. So we'll stick at Compass to the business that is, maybe it's a little bit lower return, but it's way lower risk. That's kind of how we think about it.
And what innovative financing structures are you using to fund growth without compromising balance sheet's flexibility?
Yeah, good question. I mean, we are, you know, for the last few years, we've used, you know, commercial bank capital to do the development. So we have a large facility that a lot of commercial, you know, the leading commercial banks in the space participate in as far as the development side of our business. And then when our assets stabilize, we move them out into the ABS market. We have the tightest spreads in the market, and we're very happy with that approach. You know, what we're focused on now is what a lot of people are focused on, and that's recycling the equity from the stabilized portfolio so that we can reinvest that capital back into the development side of the business, which continues to grow and require more capital.
And how does Compass decide whether to sell or retain?
So we have this year sold off some of what we consider to be non-core assets. And so for us, a non-core asset is either not the Compass prototype build, or it is not in a market that we want to be in, or it is non-investment grade hyperscale. So any asset that does not tick all three of those boxes, we have divested and fully divested so that we can really focus on, what is our core strategy. For the assets that we are retaining, we're going to keep an ownership stake. We are going to stay in operational control of those assets, but we will take on, capital partners that are looking for more of a stabilized investment return than a more speculative development type return.
So alignment and quality over quantity.
That's a good point. We are not really participating in the land grab in the extent that we're not just taking any and all business that we can find. We are really moderating our growth, and it goes back to those 4 points I made earlier. We have a closely coupled supply chain, and we plan out for 5 years into the future a certain amount of megawatts a month that are rolling off the factory lines, and we just want to execute that as best we can, and not grow for the sake of growth.
With AI and cloud infrastructure driving demand, how does that impact your capital expenditure planning and return expectations on new builds?
Our return expectation on new builds hasn't really changed, and it's back to the core business that we focus on. I would say that if we were doing more speculative builds, our return expectation would go up. The AI workloads, it's a little bit more expensive to build data centers to house AI workloads because you need, liquid cooling. At Compass, we have a hybrid cooling model, so you can literally flip a switch and move it from air to liquid. That is a little bit more expensive. It adds to the build cost. Again, similar return profile to when it was all air, but slightly higher build cost, so slightly higher lease rates, but similar returns.
Compass has partnered with major institutional investors.
Mm-hmm.
Tell me, from your perspective, how do these partners optimize capital efficiency?
Well, it gets back to the point I was making earlier about the stabilized vehicle that we are creating so that we can recycle development capital. Because the two large institutional partners that we have today are looking for development returns. Keeping all of their equity tied up in a stabilized vehicle or a stabilized data center for 5, 10, 15, 30 years, it's really not the most efficient solve. So the way that we're dealing with capital efficiency and making sure that we're optimizing IRR for our shareholders is we're trying to repatriate as much of that capital as we can, not all of the capital, but the lion's share of that capital into the development side of the business. And we're actually going to probably start doing pretty healthy distributions next year as well. So that that's obviously something that all investors look for.
And what is next for Compass?
Yeah, on the financing side, it's really focused on separating out the stabilized portfolio, continuing to work with our bank partners on the development side, continuing to work with our ABS investors on the stabilized side. And from a product standpoint, we are really focused on extending the value that we can add to our customers by doing more. And by that, I really mean the fit out inside the data hall. We've taken some of our lean manufacturing principles that we use to put up a 40 megawatt data center in 9 months, and we're applying those same principles to what goes inside the data hall. And that might be capital that's invested by the tenant, but we are, they're asking for our help with that. They can't do it all themselves. And so we are, rather than stick building the white space fit out inside the data hall the way it's always been done, there's been some recent press with our partners Schneider and Vertiv in terms of just creating a more of a manufacturing approach and productizing that fit out. So that's a big focus for us as well.
That's nice. I look forward to seeing how that goes in the future. So I'll definitely be keeping up with that. Jared, thank you so much for speaking with me today.
Yeah, absolutely. Thank you.
And as for you at home, don't forget to check out our website and follow us on social media at The Tech Capital. You lead, we report. Bye for now.